Hey, what's up guys? This is Mark from Trader Today, and in today's video, I'm gonna talk about today's FOMC Fed interest rate announcement and also how interest rates affect the stock market. And I'm gonna show you a historical chart of the federal funds rate since 1985 and explain to you how it affects the stock market in a historical sense. So I think you guys are gonna like this video. You guys are gonna learn a lot from it. So all right, let's get started. All right, so as you guys can see, this is a monthly chart of the S&P 500 since 1993. So we're talking about like a 25-year chart. And now this is the 2000. So there's a recession of the 2000. If you guys remember the tech bubble burst right here, a recession right here. And then this is the housing bubble burst in 2007, 2008. And then you see the recession, stock market pulled back. And then we have this humongous rally in the market since 2008, and it's nonstop. So of course, because of this humongous rally, a lot of investors around the world are worried about inflation and interest rates. But why? And that's what I'm gonna talk about. So let's look at it first of all, what happened today. So today, the FOMC announcement, the Federal Reserve did increase interest rate 25 basis points. So now the consensus is going to be 1.50 to 1.75% federal funds rate interest rate increase. And what they're forecasting for this year, so this year they're forecasting three interest rate hikes, which already included today's, which they're forecasting two more by the end of this year, and they're forecasting three more rate hikes in 2019, and I believe it's two by 2020. So by the end of the 2020, they feel like interest rates are going to be around 3.4%. Now that's what they're forecasting. Keep in mind that could change, but that's what they're forecasting. So this brings me a story that I did hear on the news on CNBC that of a fund manager who they interviewed him about interest rates and asked him, why are interest rates a big deal with the stock market? How does it hurt them? And when are you going to be worried about the stock market being hurt once interest rates hit a certain level? And the fund manager said that pretty much right now he sees the stock market okay. He doesn't really see anything, any interest rates hurting the stock market until it hits around 5%. So why 5%? So that's what I'm going to get into right now. So let's look into the chart, into the chart of the interest rate chart. So this is a Thinkorswim tool platform, awesome platform. I love this platform because it does give you a lot of economic data as well. So what I do is I click on analyze. There's the interest rate chart right here. Of course, I want to look at the discount Fed funds rate, and I want to look at the effective interest rate. So here it is, guys. So as you guys can see, we have history. Actually, federal funds rate since 1957, which is pretty awesome. So, but hey, let's look at the last two recessions. I think that's what's most important to really think about is the last two recessions. If you notice, there was a recession in 2000, the tech bubble burst, and interest rates peaked around actually close to 5%. Actually, if you guys can see it, it peaked around here around 6.5%. That was a recession of the 2000 recession. Now let me show you guys how that chart looks like in the S&P 500. So you guys can see, again, stock market peaked in the 2000 tech rally and tech burst, recession burst, peaked in around September 2000 actually. So it's September 10, September something 2000. That's when it peaked. And if you go back to the federal funds rates peaked around 6.5%. So that's very, very important to keep in mind. Now, and again, after that, there was a recession. Of course, tech bubble burst. There was a huge recession all the way in the 2000s, and then that's when, again, if you guys remember, Alan Greenspan lowered interest rates to stimulate the economy. If you guys remember Alan Greenspan, and now you had this again economic boom, and the economic boom is coincides with again raising interest rates, because again when interest rates go up, the economy tends to do well, And then the next top, if you look at the next peak of the federal interest rates, was around 5.6%, 5.26%. Now look, and then that peaked around, let's see, that was May 2007. May 2007, July 2007, October 2007. That's when the federal Fed fund rates peaked. Now let's look at the stock market. When did the stock market peak? Now if you look at the stock market and the housing bubble rally and crash, stock market peaked again around October 1st, 2007. And again, that coincides with interest rates peaking around May, June, actually it's July, August, September, October, around the same period, 2007. So if you guys could see the correlation, when interest rates peak, when the stock market peaks, interest rates peak, and then when there's a recession, of course, the Federal Reserve lowers interest rates to stimulate the economy, and again, coincides with the recession in the stock market pulls back. So that's the reason why the investors and fund managers are looking at interest rates, because they're seeing how fast is going to increase in terms of, when, of course, looking at inflation, make sure it doesn't get out of control. Because if inflation gets out of control, they're going to have to increase interest rates faster than usual to kind of keep inflation under control. And again, that could negatively affect the stock market. So again, keep in mind, guys, this 5% level, which is very, very important, because again, when 5%, 6% federal funds rates, when that kind of peaks, it almost coincides with the stock market peaking. So right now, if you guys could see, there's been a huge rally in the stock market since the recession of 2007, 2008, 2009, after the housing bubble crash, and there's been a huge rally in the stock market. So again, there hasn't been a pullback, any major pullback besides the 2015, 2008. That was more like a correction, not a real recession. Because in order for a recession to happen, we need to have, I believe, 2 consecutive quarters of negative economic growth, or GDP. And again, that is followed with increase in unemployment and things like that. So that's something that's very, very important to keep in mind. So right now, things do look good. Unemployment at its lowest. The economy is growing, and interest rates are slowly increasing. As long as inflation doesn't get out of control, the Federal Reserve has no reason to forecast more than what they already have in terms of interest rates. So right now, things are looking good. But again, what we have to really look at for is when the federal funds rates does hit 5%, and we're going to see how the stock market reacts around the area, and also to see how the economy reacts around the area, because that could be a peak in the economy. And if there's a recession, or if you hear economic news of people getting laid off, or unemployment going from 4% to 5% to 6% or 7%, etc., and also GDP having negative growth 2 quarters in a row, then we're in a recession, and interest rates might start going down. Why? Because the Federal Reserve has to stimulate the economy again, so they start lowering interest rates to kind of help with that. So very, very important concept to understand, guys. I hope it made sense. And let me know what you guys think. Let me know your comments on what you guys think about this. But I mean, you guys can see the interest rates, it literally coincides or relates with the stock market. So that's the reason why all the investors around the world are taking a close watch to it, because it really, really does affect it. So we're going to take a closer look at that, guys. And again, so far, everything's looking okay. Again, federal funds rates right now is actually at 1.41%. And again, they're targeting a 25% basis increase, so to 1.5 to 1.75%. And again, they're planning of increasing interest rates 2 more times this year, and then 3 times in 2019, and 2 more times in 2020. So by the end of 2020, they expect interest rates to be at 3.4%. Okay, guys? So that's very, very important to keep that in mind. And again, as investors and traders, we're going to be keep looking at economic data, and also the Federal Reserve announcements to see if this still stays the same, because this could change. Depending on inflation, this could change. They may increase interest rates faster if inflation gets out of control, or they may increase interest rates slower if inflation stays at a moderate pace. So that's why it's very important to keep every single jobs report. Keep a look at the jobs report, and also keep a look at every single Fed FOMC meeting and also interest rate raise, and also forecasts. All right, guys. Hope you guys learned something from this video. I know it's a lot, but again, I was able to explain why interest rates are so important and how it affects the stock market. Again, I showed you guys a historical chart of 25 years of the S&P 500, which is the general stock market, and also how it coincides with interest rates during those periods, with the federal funds rate during those periods. And as you guys can see when interest rates do peak around 5 or 6%, we kind of do see almost like a recession or peak in the stock market. And again, we saw that in the 2000 recession, or the tech bubble burst, and we saw that in the 2008 housing crash burst and recession, and that coincides with this chart here in the federal funds rate. All right, guys, hope you guys learned something. Feel free to reach out to me, put on some comments, follow me on Facebook, follow me on Instagram, and you guys will hear from me soon. Have a good one.